In the last class, we have discussed how to calculate the claim on loss of stock and how to calculate the claim under average clause in respect of loss of stock. Now, today we are going to discuss insurance claim under fire policy under a different head, that is loss of profit insurance, that is consequential loss policy. What do you mean by that? Loss of profit insurance. Loss of profit insurance means, see, when a fire breaks out, the normal business cannot be conducted for some period. That period may be called affected period. So during that affected period, the profit which we were earning normally in the previous periods cannot be achieved. So there is a loss in revenue during that affected period. If there is a loss in revenue, naturally there is a loss in profit. So in order to cover that loss of profit, we will take an insurance policy. That policy is called loss of profit policy or consequential loss policy. Now we are going to discuss how claim is to be calculated in respect of consequential loss policy or loss of profit insurance policy. Now we will discuss with an example. You see, loss of profit insurance. We want to calculate loss of profit insurance. First of all, the formula is this: loss of profit claim is short sales into GP ratio. Short sales into GP ratio. Now, what is short sales? Short sales is standard turnover minus affected period turnover. Short sales is standard turnover minus affected period turnover. Now, we will take an example. Period affected by fire. Suppose the fire has broken out on 1st August 2015 and the dislocation continued, suppose up to 1st December 2015. In that case, what is the affected period? Affected period is from 1st August 2015 to 1st December 2015. That is the affected period. Now, what is standard period? Standard period means the period in the previous year of the fire. Standard in the previous year of the fire corresponding to the affected period. That is, if the affected period is 1st August 2015 to 1st December 2015, standard period is 1st August 2014 to 1st December 2014. Now, affected period turnover or affected period sales. That is the sales achieved in the affected period. That is the dislocation period is suppose rupees 1,50,000. Then standard turnover. What is standard turnover? The turnover which we have achieved in the standard period, that is in the previous year, in the corresponding period is 4,50,000. So naturally, we expect the same turnover, suppose 4,50,000 in the affected period also, but we didn't get that turnover, we got only rupees 1,50,000. So what happens? Last year's 4,50,000 in this year in the same period reduced to 1,50,000. Naturally, there is a short sales, means reduction in turnover of 3 lakh. So short sales is standard turnover minus affected period turnover. Short sales you get. And you have to calculate the profit which is lost in this short sales. How will you calculate the loss of profit? So you have to calculate the GP ratio. For that purpose, you have to calculate the GP ratio. How will you calculate the GP ratio? See, net profit plus insured standing charges divided by accounting year turnover into 100. I repeat, net profit plus insured standing charges divided by accounting year turnover into 100. Suppose the net profit means net profit in the previous financial year is 1 lakh. Then what is insured standing charges? Standing charges means fixed charges like rent, salary, etc. That is included in the insurance policy, which is covered by the insurance policy, is insured standing charges, that is suppose 20,000. So net profit plus insured standing charges divided by accounting year turnover. Accounting year turnover is the turnover in the last financial year, that is the financial year just before the year of fire. So net profit plus insured standing charges. Why this insured standing charges is added to net profit? This insured charges would have been, actually it had been deducted in the previous year. So in order to cover that standing charges, we will add it to net profit. So net profit plus insured standing charges divided by accounting year turnover, previous year turnover into 100. And you get 20% GP ratio. Then how will you calculate the claim? Short sales, that is 3 lakh into 20 by 100 GP ratio, you get 60,000. This is the loss of profit claim. So the step is, first you have to calculate short sales. How will you calculate short sales? Short sales is the difference between standard turnover and affected period turnover. What do you mean by standard turnover? Standard turnover is the period in the previous year corresponding to the affected period turnover. What do you mean by affected period turnover? Standard period is the period just before the year of fire, that is corresponding to the period of the affected period. Then affected period is the period actually affected by fire. Standard turnover minus affected period turnover is short sales. Now GP ratio, net profit plus all insured standing charges divided by accounting year turnover into 100. Then you get GP ratio, short sales is multiplied by GP ratio, you get the claim. This is the normal problem. Sometimes there will be an increase or decrease in trend in this year. In that case, when you calculate the short sales, the standard turnover must be increased or decreased to that extent. I will give you an example. Suppose in this case, there is an increase in trend. In this year, you may earn, if the normal business had been conducted properly, if there had been no fire, then naturally there would be an increase in profit of 20%, suppose. And in that case, you expect a 20% increase in the standard turnover. So in that case, what will happen? This 4,50,000 will be increased by 20%. That is, standard turnover is increased by the trend. Then 4,50,000 plus 90,000, you get 5,40,000. This is the adjusted standard turnover. In that case, what will be the short sales? Short sales will be like this: 5,40,000 minus 1,50,000. You get 3,90,000 will be the short sales. Then when you calculate insurance claim, 3,90,000 into 20 by 100, you get claim of 78,000. So there may be an increase or decrease in trend. If such an increase or decrease is there, you have to add that increase. If there is a decrease, they have to deduct that decrease from the standard turnover. Then you get adjusted standard turnover. Adjusted standard turnover will be deducted from, affected period turnover will be deducted from adjusted standard turnover. Then you will get short sales. Then into GP ratio, you will get the claim. I hope you understand how to calculate insurance claim under consequential loss policy. And that's for this day. We will meet in the next class. Bye.